That's the power of geometric growth. So geometric growth, what is that? It's geometric. It was basically originally the science of measuring the Earth's geometry. So now includes all forms of measuring the magnitude in general. So geometric growth is the measurement of velocity of growth. So it's the rate of change or the rate of growth. So when we talk about geometric growth, it's just that it's the velocity at which our account is growing, rather than just saying, okay, well, instead of just measuring our account in a linear growth fashion, so according to a line, we're measuring it using the power of compounding as well. Because remember that as we started to grow that account, we're adding positions, and you'll see. I'll just jump back to that spreadsheet that the power of doing that and the power of taking advantage of those, and we'll just go to a fixed ratio. So once we started to get some, and we'll just push down here as we go, that'll switch over in a second, and I'll take you down here so you can see that with these formulas as we're going through, we're starting to, as we start to get winning trades and we go through winning runs, you'll see that the contract sizes start to quickly mount up and build, and you'll see we go from 3 to 4 to 5 to 6 to 7. It's a bit slow, it's got a little bit of a delay on that spreadsheet, but that is the power of having a money management formula or a calculation or an algorithm that tells you when to increase your contract size and when to drop your contract size. So by us doing that and having that formula set up that automatically tells us, at $2,500 we are increasing our contract size, and then it tells us exactly when we add our next contract, and it tells us when we actually reduce our next contract to protect our risk in our account. That's a very powerful way of leveraging off the rate of growth in your account. And obviously when your system's performing well, you're going to do really well, because you're going to be taking advantage of growth in the account. When your system's performing not as well, then you'll be dropping your contract sizes down accordingly, just to protect your capital. So rather than just letting your account just trickle along and waiting for that fixed fraction amount to come into play, we are going to be working as a group on working out these formulas to increase our contract size. And it might look as though there's a bit of work in this, but it's actually very, very easy, and you'll get it quite comfortably. It's not hard at all. It's just a matter of working out how aggressive or conservative you want to be, and that's why once we get all the accounts in, and we've got everyone's first week of trading in, and then we can start to see how aggressive and conservative we want to be in our accounts and how each of us go. So the power of geometric growth is shown in that example where we looked at where these accounts ended up with money management. So money management is really, if there is a secret to trading, or a secret to the power of trading, it's definitely money management, and possibly trade psychology, but money management would be one of the key things. So it doesn't really, we spoke a couple of weeks ago about the percentage that we allocate to our system entry, and we said it's about 10%, and some traders are even convinced that random entry, so it means going in at a certain time, and basically going in with a non-directional approach to the market, will have an outcome as good, if not better, to a specific entry point. So we spoke last week about indicators and making sure that when we trade, we've got the best entries. Well, that's 10% of our system. This is where the value of our system is. It's in the money management. So that's where we're going to be spending a lot of time. Now, just to recap, we know that that geometric growth is the power of this money management on our account, so compounding, adding contracts, compounding our winners, and one of the things we're going to have to look at is how to actually protect ourselves from a losing run, which we saw later in this data in September. We saw that we got a significant drawdown in September. So one of the other things we want to do is basically, one of the things I want to address with you now too is that what we're going to talk a little bit about asymmetrical leverage. Now this is the ability to be able to make up losses. So what happens to us when we're trading is that what generally happens is if we get a strong run of winning trades and we build our trades, build our account up, and we have a really good run, it's very difficult for us to actually make up, once we go through a losing run, it's very difficult for us to make up those losing trades if we've added contracts and then we suddenly get aggressive on and reduce our contract sizes down aggressively, then it's very difficult for us to actually get back up to that previous equity high. If say we're trading here, we hit 150 on our equity curve and we decide, right, well, I'm trading at 150, I've got 5 contracts in the market, and then suddenly we get a bit of a drawdown, we start to get some losing trades, and we decide, right, well, I'm trading 5 contracts, I'm a bit nervous about the way this system's running, I'm going to knock it down to 1. So how hard is it going to be for us to recover those profits if we've gone from 5 contracts to 1 in that very short period? How difficult or how long is it going to take us to get back that profit that we've lost, which is there you can see is a 50 grand drawdown based on that there, because we've gone from 5 to 1. It's going to take a long time for us to get back to anywhere near what we had if we've gone back to 1 contract. So one of the biggest challenges for us when we're trading like this, where we increase our contract sizes and then we go through a losing run, is knowing when to jump back in and take our contracts back up to a level where we can get that geometric growth. Because who knows when we're going to go from a losing run to a winning run and how that's going to be sustained. So we don't really know that magic formula, do we? We don't know when that's going to happen. And what I'm going to show you in the sessions as we go forward is how to take care of this when we get a good run up, we hit say 150, and then bang, we get belted with a losing run. How do we reduce because that's a 50 grand drawdown. I mean, admittedly, it's made 150, but if you were trading and you did all this work, set up your trading system, tested it, started trading it, spent every day trading, and then you built your account up to 150,000 and then you took a 50 grand drawdown, how would you be fairly disappointed with having such a big drawdown on the account after you've done so much work to build a profit up? You'd be pretty disappointed with that kind of a drawdown, I would imagine, particularly considering you've gone from 0 to 150 and then you've taken that big of a hit. So our goal in this program is to show you how to build the account up without taking this kind of a hit, because that hurts. That is really nasty, and we need to work out a way that we can avoid, because every system is going to go through these losing runs. So how do we as traders put in place a mechanism to help us protect our profit when we've got a drawdown? Because this is a bad run. That's just a really bad run. How do we protect our profit, but also how do we get back into the saddle and get back going when the winners start coming? Because we want to know when the system's back on, it's trading its normal range, it's delivering profit. So that's some of the challenge that we've got. And then when we talk about asymmetrical leverage, that's just a technical term for the ability to recover these losses. So anytime we're trading, Geometric growth talks about the potential or the growth that we can experience on our account from compounding and adding contracts, and the growth that can come from that. The asymmetrical leverage part is how to avoid, well, number one is how to avoid a savage drawdown. So how do we put a handbrake on the account so it doesn't give back so much? And then how do we recover quickly so we don't get disadvantaged here from taking months and months and months to get back to where we were at our previous equity high? So therein lies the challenge. Those questions will be answered as we go forward because we have the solution. So it's an interesting exercise. It's one that you'll enjoy doing, I'm sure, because it is definitely an eye-opener as far as getting the most out of your account and squeezing every last bit of juice out of it. So we're going to definitely be looking at every way in which we can, every facet of the money management of our account. So any questions so far? Because I'm going to flip straight over now to the backtesting rules for the trend trader. I'm going to spend about 10 or 15 minutes on that, and that's going to wrap us up. So any questions before we finish the money management week 2? So what I'm going to do this week, as soon as I get the last of those accounts in, I will send out the first week's worth of data, and then I'll get you to shoot me back your second week of money management, your second week of account, what you're going to have on your account, and we will basically go to week 2 and see how we all performed. So I've spreadsheeted that up, so that should be pretty easy to do. I just need to get a couple in. I think I'm waiting on 2, and then we're away. So I'll just close it down. Any questions before we move on to